Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. Bruno, welcome.
Good morning, Paul.
Good morning. Ramsey, you're joining us from a different location today.
Yes, my new home in Vinings, Georgia.
Excellent. All right, we got a great guest. Ramsey, thank you for arranging this.
I don't think I arranged it, but I'll take credit.
Okay.
I think it was Bruno.
Was it Bruno? Oh, it was Bruno.
Yeah,
We're one
Bruno.
big happy family here.
Okay.
So
Give
you go for
credit
it,
where
Ramsey.
credit is due. Yeah.
Yes.
All right. Go ahead, or am I going straight into intro? It's up to you.
Yeah, please.
Go for it.
All right. So we're lucky to be joined today by Arun Muralidhar, who is who's been out. We'll say it. He's been a bit of a rabble rouser in the retirement industry over the course of the last few years. He is obviously very accomplished in many ways, and you know, in academics, and has worked with a Nobel Prize winning academic to do much of the work that he has done. So today we want to do a few things with Arun. One, we want to find out how he ended up where we all are, which is focused on retirement, which is it's always an interesting journey. Sometimes it's painful, but we all have our routes to get here, to have committed our careers to this. And then beyond that, would like to find out more about Arun's innovations and why, Arun, why you think that they're important to society. So with that, tell us how you started your journey.
First of all, thanks, Ramsey, Paul, and Bruno. Really appreciate it. Just in the pre-conversation, just laughing it up with you guys tells me it's going to be a fun discussion, and that's kind of what this whole thing has got to be about. Because if you look at the statistics, it's actually a pretty depressing topic, right? And how I came to this was I joined the World Bank as a 26-year-old kid. In my introduction, they're asking me who should get your pension benefits when you die. And I'm not even thinking about that. I'm trying to figure out where the next party is at. But I had a defined benefit. It was an incredible defined benefit, not only payable in real terms, but in the currency of your choice, right? Ended up working on the desk at the World Bank issuing bonds for them, which was my first job. And then my boss moves over and says, come and work in the pension area. And, once you've sat on a trading desk, to go and sit in a pension department is kind of the most boring thing you can do. But the luck of working for the World Bank was they would send us off on trips where the World Bank was advising countries on how to reform their pension systems. And then, you were ostensibly the technocrat. And I was on a trip to China, actually pretty much, this was 1998 April. And I'd taken along a young analyst of mine, Ronnie van der Wouden. Because, we figured we'll go out clubbing and enjoy China at that time. And then on the ride from Shanghai to where the conference was being held, I heard all these academic World Bank people, mainly labor economists, talk about how, defined benefit is a terrible thing and why they needed to get these Chinese to put all their money in a defined contribution system. And so I lost it because all of them had very secure defined benefits, and I started a massive fight with them. Fought all the way back on the flight from China to Washington, D.C. and nearly got thrown out of a couple of planes and airports.
So this is a pattern.
Yeah, there is. Yeah. You can see, you can light my fuse really quickly. And the problem was these people had no clue about pensions, right? They had made the mistaken assumption that Social Security, which had three elements back in the time, it was pay as you go, run by a government, and then typically, public sector, right? So, that's the three things these guys had. And these folks do the projections. This is 1998, which say Social Security is going to collapse. So let's change it from pay as you go to funding. Okay, that's good. Let's change it from DB to DC. And the answer is, okay, why? And then the last one was, let's go public to private. And again, the question is why, right? And because I was young, they kind of blew me off. And so I called up my advisor, Professor Franco Modigliani. So I've had actually 2 Nobels. Ramsey, I hate to brag.
Go ahead, claim it. Go ahead.
who actually, his first paper that he writes on, life cycle hypothesis is actually such a beautiful paper that describes pensions to begin with, right? And at some point, I'm happy to walk you guys through that. And I call him up and say, Franco, am I nuts? These people are going to these poor countries and they're going to transfer wealth from the poor to the rich, because in a completely undeveloped market with people with no financial sophistication, you go to the private sector and say, by the way, provide these people with pensions. They're going to be paying high fees and they're going to get a lottery, right? Because nobody knew how to manage assets. Long story short, I quit the World Bank out of protest. We write a book that predicts what would happen in Latin America and Eastern Europe, where the World Bank was successful. And sadly, I take no pride in saying we were absolutely correct, because literally they impoverished the poor. They enriched the rich, which are the asset managers, and people were retiring poor. And that's why Chile and all these countries ended up having to bail out their retirees, and countries in Eastern Europe reversed their systems. So we tried fighting it in the US. Actually, under Clinton, we got close to saying we can reform Social Security, because the US Social Security was on a similar path. Sadly, there was one unusual event in the Clinton presidency that derailed everything. And from there on out, Social Security has sadly gone down the tube even faster than we had predicted in our book in 2004. Right. So
was that an economic event, or was that a social event?
Social event.
Okay.
The most famous one that we remember, sadly, Bill Clinton by. But he actually was very receptive, because he was running surpluses, right? And we said, take those surpluses, put it into Social Security, run it like a well-run DB, don't screw around with this horrible formula and give Treasury free money. And sadly, nobody listened. And, we could have actually sustained Social Security permanently with a slightly higher contribution, as opposed to now Social Security running out of money in probably the next 6 or 7 years. And then all of us either having to take a benefit cut or taxes are going to go up, right? So predictable, easy, but people just weren't trained to run a pension fund to then, inform policy, right? So sadly, US Social Security is as bad of a mess as any other. The only good thing is they didn't go to privatization, which is what the Bush administration wanted, right? So I gave up on that. I managed pension assets for a living. I went to the dark side after I quit the World Bank. I went to work for JP Morgan, and then I set up my own pension management company. So I managed pension assets for a living. And then about 8 years ago, Kathleen Kennedy, Bobby Kennedy's oldest daughter, came to me somehow and said, I hear you're the nut job who likes to work on retirement security. And I said, yes. And she said, do you realize that 50% of the people in America don't even have access to a pension? I was oblivious to the statistic. And she was setting up a center at Georgetown University and needed an academic to be able to create the center. It's called the Center for Retirement Initiatives. And I said to her, Kathleen, I've fought this fight for about 12 years and I've had zero success anywhere in the world. And so I've got better things to do with my time. And if you've never interviewed Kathleen, you should do it, because she just chewed my head out and said, how dare you? You're going to work on this like you like it out. And so that's how I got into this whole thing about trying to help uncovered people, like your Uber driver or the person, cutting your grass, try to get a secure pension. And interestingly enough, I went from having a superb DB. Both my wife and I were World Bank employees. And if we had stuck it out, we'd have, been living an extremely comfortable life, with the replacement rate well above 100% with inflation indexation. But because I quit, I had all these DC plans, 401ks, which are a complete disaster, even though I manage money for a living. And so, you'd get the statement that says you have $500,000 in retirement assets, but you had no clue about what the lifestyle was. And so because Kathleen brings me into this thing and nobody is willing to offer a DB, the question was, what kind of a DC plan can we get these poor people that allows them to keep their wealth and not pay away high fees, but still get a guaranteed retirement income or whatever? And so I started doing a lot of reading, and I read a lot of Bob Merton's work. He was one of the earliest people to get on this bandwagon of saying, hey, wealth is not the goal in DC plans, it's retirement income. And he phrased the problem really beautifully, which was the goal of retirement should be to allow people to maintain their pre-retirement lifestyle without adjustment, because that's difficult to do. And so one day I'm reading Franco Modigliani's life cycle hypothesis paper all over again. And I just, if you remember what his idea was, is the reason we save is during our working life, we have income. And then when we hit retirement, we don't have income, but we have continuous consumption, right? So in order to finance the consumption at the end, let us save at the start. Right? It's such a beautiful paper that I recommend every kid read it, right? Because it's high school math and just absolute genius. And just by chance, I happened to cover the accumulation part, saying, what's the goal of retirement? And it just struck me, it's nothing but a series of cash flows, which then sort of lit a fire under my head, which said, hey, that's just a bond. If somebody issued that bond, wouldn't it be perfect? And that's what led to selfies, right? Was, what is this bond? Who should issue it? And then when you write it out, it was so trivial that I kind of felt stupid that I hadn't thought about this when Franco and I were fighting Social Security, back in the late 1990s, right? So that's kind of been my journey. And now it's my mission. I don't make any money. I didn't patent it or anything because, Franco and I genuinely wanted to ensure retirement security for the poor around the world. And Kathleen, being sort of my older sister, I guess I can call her, is not going to allow me to do that. So I literally do this pro bono. I actually lose money doing this. But I think to our earlier conversation, society can't be a good society if you have a lot of people retiring poor and you have a separation of wealth between the rich and the poor as well. So that's been my journey now. So I still have a day job managing pension money, reasonably unsuccessfully, I might add. But this has now become my passion. And that's why I'm even teaching at Georgetown now. Because if we don't tell kids in college to start saving, they're just not going to have a safe retirement, right? So it's a life skill that I teach them. I don't think it's an academic class.
So what does selfies stand for?
Okay. So I'm fortunate that, the first thing I learned at JP Morgan was, just learn how to market stuff, right? You can be a terrific portfolio manager, but the only guys who have jobs at JP Morgan are the marketing guys. And then I'm married into a family of advertising people. So selfies basically stands for Standard of Living Indexed Forward Starting Income Only Securities. Okay? So what we were advocating for is if the government issued a bond which paid you nothing until you got to retirement, and then at retirement paid you a steady stream of cash flows, and we'll go into more details in a second, and indexed to standard of living, which is Bob Merton's sort of, thought back in the 1980s, right? That is, don't index just to inflation, you got to index to standard of living. So you then have something that standard of living indexed starts at a forward date, which is your date of retirement, and it only pays you income. It doesn't have this big stub principle, which is what's typically embedded in bond instruments today. In a bizarre way, it's nothing more than an annuity in a bond, sort of a term annuity in a bond, but, I figured a cuter name than annuity would help market it. And so that's where the word selfies comes out, is standard of living index, forward starting, income only securities.
So I was one of those guys just at Goldman Sachs. So I appreciate the the marketing chops there.
Yeah, and you're a marketer, Ramsey, right?
Oh, he is. He is.
So help me understand a little bit about what kind of liability that means for the government. So how is it funded? So I can see why. I guess if I took Social Security and I basically just changed Social Security from its current construct and I moved it to a standard of living indexation away from the COLA, I feel like I'd end up in the same place that you just got, except it's not structured as a bond, right? And so exactly. So then my question then is like, so how do we have funding problems with Social Security because it's a pay-as-you-go system? How would it be different for selfies? Like what would the government do to sort of better assure its funding over time? Is that part of your analysis, your suggestions as well?
So here's the thing, right? Is let's start with one very clear aspect of it, which is 95% of the people have zero financial sophistication to be able to make correct decisions for retirement, right? Because it's a really complex problem of, compounding, consumption, how much to contribute, what to save, where do I invest it, how do I rebalance, how do I decumulate, right? And one of the best papers you'll probably read on this topic is Zwi, Bodhi, Merton, and Samuelson, but you've got to have a PhD in physics to just understand the math. And then, way more capabilities than even I have with my investment team to actually play that game out, right? So that was my starting point, was you can't develop a societal solution if that's what you require. And that's where the Modigliani piece makes it really simple, which is, hey, that's all I need is these simple cash flows payable in real terms from the date of retirement till ostensibly the date of my death. But look at what's happening in your DC plan today, right? If you've got a 401k or a Roth or whatever, you're holding current US treasuries to some degree, which have such an incredible cash flow mismatch between what you need in retirement, which is nothing till 65. Let's keep it simple. And let's assume we know you're going to die at 85, and I'll come to that in a second. And all you want is a steady stream of cash flows, whereas when you buy a treasury today, they're giving you cash flows now, and then at 30 years, suddenly one stub principal, and then you've got to sit and reinvest all this stuff. Right? So what's happened today is US Treasury has issued a lot of debt, which is incredibly risky relative to my retirement profile, which means that if a whole bunch of us retire poor, the government's going to have an obligation to bail us out. So my argument to US Treasury, and actually I've met 3 administrations of treasuries, and it's been pretty sad how poor the quality of US Treasury officials has been, was to say, listen, instead of issuing the garbage that you're issuing currently, which is in the 401k plans, it's in the target date funds, right, in these DC plans, why not issue the debt that's essentially the lowest risk possible debt for people to hold in their DC plans, right? So the fact that the US government already has 34 trillion when I last checked of debt outstanding, let's take 10 trillion of that and issue to selfies. If that's the obligation that we need to make people secure in retirement, it's 10 trillion. Why not just change the structure of the debt? And it's a way better deal for the US Treasury, and we can go into that in a second as well. But the funding is already there. The US government is issuing debt, right? So I'm just saying replace the garbage debt that they're issuing now and issue the debt that's really relevant. And Brazil got this in like 5 minutes, right? So if governments were not issuing the debt, then your question is very relevant. Now, where this differs from Social Security is because it's a bond, I can buy it, but I can sell it instantaneously. Okay, it's at zero cost, and I have a price every second of every day in which the markets are open. I don't have that with Social Security, right? And Social Security's obligations technically can be changed by Congress. Whereas once I buy the bond, as long as the US government doesn't default, and we'll come to that in a second, I'm pretty much assured that I'll get paid out, with close to zero risk. So it becomes yeah.
So let me understand. So I'm a retiree. I get issued a selfie, and now I can sell the selfie. Like, I think you don't want me to sell the selfie. I think you want. I think from a policy perspective, I want you to force me to keep the selfie.
No, absolutely not, because there are life events that are going to interfere with your decision to retire, right? And Franco had a beautiful idea, which we can come to in a second. If I always know how much, so the beauty of this, okay, let me describe selfies in a little bit more detail so you'll see why you like the design, right? So let's keep it super simple. Every selfie pays you $10 real per year. Okay? So you buy one instrument, it pays you $10 real per year for 20 years. Why did I pick that amount? I picked it because if my goal is to have $50,000 of additional income over Social Security in real terms, then the only goal I need to have is I have to buy 5,000 of these bonds before I retire. Okay? That's it. No other math. So in Brazil, on an app, we ask people 2 questions. What's your date of retirement and what's your target income? Once they answer that, no more complicated compounding, inflation, all that BS, right? That keeps finance academics, employed. I've taken that whole equation out. The beauty of it is now when you get your statement and it tells you already have, 1,000 selfies, you could now decide, do I take more risk? Do I save more, or do I postpone retirement? If I have an emergency or I want to go on a flyer or a bender out to, a local distillery and get smashed, sell my selfies, but then you'll know tomorrow you've only got 9,000 locked in, right? So while the government may say, yes, I don't want you to sell it, people have life events. You could have an emergency for which you have to have the liquidity. To have money locked up forever and then go and borrow it on my credit card or through a payday lender is probably the worst trade you can do. And that's why I'm completely against dumb auto-enrollment and auto-escalation, right? Because these are idiotic strategies which don't check what people's financial conditions are during their saving pattern, right? So a lot of these guys in academia have no concept. And Franco had this back in 1985. He wrote a paper, I think even 75 maybe, where he said auto-enrollment and auto-escalation. He didn't say it in so many words as I did. We should allow people to borrow from their retirement accounts, because if they have a need to finance some consumption, it's cheapest to borrow it from yourself as opposed to going and get it from MasterCard or Visa or from the payday lender. And guess who shut him down in Congress? The credit card companies, right? So we have to give people maximum flexibility to plan their lives, but give them the information so that they know that, hey, if I spend 1,000 of these bonds, either I'm going to have a lower retirement lifestyle, you'll know that instantaneously, or I need to save more or take more risk elsewhere or postpone retirement. So that's where I'm very much against telling people what they can't or cannot do. People are intelligent. And if you saw my post today, it's kind of a bit of a sort of flame-throwing sort of post about why annuities are terrible and why there's an annuity puzzle. But I think we're not giving people the right information, and therefore we're trying to box them in with these idiotic policies, and that's going to cause even more problems down the road. Right? Does that make sense, Ramsey, in terms of the design?
Yep. No.
So I understand. Sorry, I'll wrap up and then hand it over to Bruno. So yeah, I mean, look, I understand why you want them to be tradable. Maybe I don't necessarily agree that you would want to let people. I'd want them to be tradable, but I'd actually want people to in some sense be obligated to hold them at least until retirement. That's probably the one difference that we may have. I do have a question though, is everybody's trading these selfies, are the selfies sort of personalized? Because when I turn 85, right, I die. So then what happens to does the selfie disappear? Or
it's not. So that's the beauty of the design, right? Is in a typical annuity contract, right? If you die young, then your family gets nothing, right? I'm just taking a very simple annuity contract. Sure. You can come up with extra clause, but then that jacks up the price. The beauty of this instrument is, I'm a heart patient, so I'm probably not even going to make it out to life expectancy, right? It's a clean bet. I had a widow maker. So I'd be stupid if I expect I'm going to have 20 years of life expectancy post-retirement. But the good news is, because the selfie is just another financial instrument, my kids inherit it. Or if my wife is nice to me, I'll give her some too, right? She can then decide whether she wants the coupons or she wants to sell it and say, hey, listen, it was such a terrible lifestyle living with Arun. Let's sell all his selfies and go and have a good time celebrating that he's gone, right? So we wanted to make it so marketable, so liquid, inheritable, zero cost. And in Brazil, people can buy it in slices as small as $5 at a time, right? So you're an Uber driver. I tip you $5. You can actually buy a slice of a selfie with that $5 because it's all maintained on an electronic exchange. So we've now made it so easy for anybody at any income strata with any level of education to actually buy guaranteed real retirement income for 20 years. And we'll get to longevity in a second, right? So dying early is actually an easy problem for me to solve. It's if they live beyond longevity, how do I manage it? So the reason I picked average longevity of the economy for the maturity of the contract is minority populations and the poor typically have an average life expectancy less than the average, right? So in Social Security, actually the minorities and the poor are subsidizing the wealthier and the majority communities because they have longer life expectancy, right? In this one, I'm actually splitting that out and removing that subsidy completely. So here's where I was trying to right the wrong, which is if you're trying to help poor people or minority communities actually have a secure retirement, give them an instrument which has zero subsidy at all. Right? Let it be freely tradable. And then if you want to do welfare stuff on the side, you can do that. And we can talk about what Brazil has done in some examples to get better social behavior. But to your one point, what we did in Brazil was if you sell it before the maturity of the instrument or when it starts to pay coupons, essentially, we charge you a custody fee, and the custody fee declines over time. So that's kind of the penalty function that we impose on people, which is, hey, you're selling it before it starts to pay. You're now paying a small penalty, but if you held it to maturity, then guess what? It goes to zero. So we've got those kinds of incentives, which are financial incentives for people to hold, as opposed to requirement incentives that would be different. Does that make sense, Ramsey, in terms of what we were trying to do? It's not going to hit all the problems, but we're trying to kind of
go. I understand your thought process, but I want to hand it over to Bruno. I know he's been chomping at the bit to.
Well, we're basically reiterating the same topic, and I think we have gone through the administration and the benefits, but I want to drill down a little more on the risk pooling aspect of it. So you said that 20 years is kind of the sweet spot in terms of paying out, and that the particular issue, which to Ramsey's point, is not like Social Security. You're not like with Social Security, you're not holding a security. With selfies, you are holding some sort of security. That security can get passed on. You mentioned that some of the subsidies between the wealthier portion of a population versus the less wealthier portion of the population gets equalized. My question is, what are the risk pooling mortality or longevity mechanisms that are embedded in selfies?
So in the selfies, there's none, right? We wanted to be a really clean instrument where the big problem was, how do I finance people from the date of retirement to average longevity, right? So we said, let's just take that chunk, and I'll come to longevity in 1 second because you've asked a tricky question, and it can be solved quite easily. But just to be very clear, in each country, the maturity will be linked to the average life expectancy of that country. So it's 20 is not arbitrary across the board for all countries. In Canada, if you have a longer life expectancy, then it's, the country has an incentive to actually stagger it out. But then the longer that the country pays coupons, the higher the price. And so you have to play a few more games in terms of what happens, right? But again, an intelligent sort of policymaker would say, hey, my minority population is 3 years short of the average. And so that gives me enough of a distributional cover so that most of the poor people don't have to go and buy longevity insurance outside of their experience with these instruments, right? So that's one. The second, there are two angles to which we hit longevity hedging after that. One is, if we design this instrument really well, and Bob and I have written about this, then actually an insurance company has an incentive to go out to people and say, listen, you're 45. You have no idea whether you're going to live to, 85, 90, or 65, right? And I could say, I've had a widowmaker, but chances are, with my bad luck, I'll live to 90, right? And I don't know that upfront. But if there's an insurance company that gathers enough people, then the insurance company's experience for now, let's just assume that we know what average longevity is, and we'll come to that problem as well, because I can address that. Their experience is the average because they've got enough diversification across people. So Bob and I basically said, in a classical theoretical sense, the insurance company should be willing to tell anybody that's willing to turn over a selfie, we'll give you exactly that same payment for life. Okay. But if you turn it in and you die young, you lose your coupons, right? But in the pooling sense, the insurance company that's created that has sufficient diversification should be willing to do a one-to-one transfer. If they say, hey, you give me a selfie that pays $10 and I'm going to give you back $9, then the insurance company is not diversified because they don't think they'll hit the average, right? So actually the pricing of annuities relative to selfies will exactly tell you how diversified these insurance companies are. There's one risk that the insurance companies still have is, here I've assumed we know what average life expectancy is going to be, but that's moving. And Bob Merton's point was always that that's something that moves relatively slowly. He called it low tracking error, right? It's not as volatile as interest rates or inflation. It's the slowest moving part of retirement. And so I actually designed another bond, which comes in and starts after selfies, and I called it the Longevity Indexed Variable Expiration Bond. And what's the acronym for that? The LIVE bond, right? And that bond actually starts paying after 85, and it pays based on the cohort. So that's a much more technical instrument that actually hedges out your longevity pooling. Okay? So you run the longevity pooling at the level of the macroeconomy. The government has every incentive to issue this bond, which follows after selfies. So the simplest idea was, a well-run insurance company can now offer guaranteed real retirement income because it has the instruments to hedge it with, which is selfies. And if they're diversified across various cohorts and various types of groups, for each cohort, they'll have ideally the experience of average longevity, and therefore they should be willing to do the trade. So we want the private sector to bear that risk, right, for a price. We're not going to do that at the macro level, except we want the government to issue instruments that allows the private sector to actually be able to do this efficiently, which today is not the case, right? You can't get a real retirement annuity in America because there aren't good instruments and tips are crap, right? They're complete garbage. The Treasury asked me, why is it, unsuccessful? I said, because it doesn't suit anybody's purpose. Who the hell wants an instrument that gives me some weird coupon and then some doubled up inflation at the end of the principal? That doesn't meet any cash flow of any individual in any situation or institution. So guess what? It's going to be a lousy instrument, right? Designed by Larry Summers, an academic, brilliant guy, but clueless about managing retirement assets. Right? And this is the problem we've had too many academics writing papers that influence what policymakers in these central banks and ministries of finance do. And that's why you're going to have a guaranteed retirement crisis. And touch wood, Brazil just gets it in 5 minutes and they're off to the races. And we can talk about some of the innovations they've added to this instrument, which addresses all these questions as well. Right? So that's how I've split it up, is let's have cash flows first, completely clean, no subsidizing, no pooling at any level, right? If you then want to create tontines or, insurance company products, because all these guys like Moshe, you guys have interviewed Moshe and others, they're busy flogging tontines, right? But without this instrument, the tontine is a garbage product as well, because the income that you get out of a tontine is highly variable and they're not real hedged either. And that's what these guys who are, pushing tontines don't realize, is if they don't have this instrument to manage the tontine assets, they're going to be giving people a very limited income, but for life. Big deal. If I get 20% of what I should have been getting, tontines are a horrible product, even if it pays through life, right? So without this instrument, actually, you cannot have any development of real guaranteed lifetime income. It's just simple math, right? Does that make sense, Bruno, or am I sort of going off on a tangent?
No, absolutely, and that was the exact idea. And what I take from you is that the selfies are not designed to be the risk pooling mechanism per se, but they are the vehicle through which the private sector can manage and offer such solution.
Yeah. So in fact, I don't know if you saw my post today, and Franco, who's my advisor, in his Nobel Prize lecture, which is again a beautiful paper. If you haven't read it, I'll send it to you guys after this class. Raises the question of the annuity puzzle, right? It's the first time it's ever referenced in the literature, which is why aren't rational human beings who are utility maximizers, that was his context, bless you, Ramsey, why aren't they purchasing annuities? Well, from a welfare point of view in traditional microeconomics, looks like a superb deal. And my point was because people are rational, because today insurance contracts are complex, inflexible, costly, right? And you cannot buy them in small slices. So it's completely rational behavior on the part of individuals to not want to buy this instrument, which is kind of ripping you off because the backup hedging instruments don't exist. So, there are all these papers about, all this, what's it called? They go off into these academic terms about why people don't buy annuities. Nah, people are smart. You give me a lousy product, I don't buy it, right? It may look good academically, but if you're asking me, I'm a professional, right? I looked at one annuity contract document and I said, I will never buy this crap, right? I'll never buy it because it was so complex. Whereas in selfies, I'm asking people two questions. Date of retirement, how much do you want in your current lifestyle? Bang, that's what everybody can answer, right? So we have to make the product simpler, but you can't make annuities simpler unless you have the right hedging instruments. And hopefully then you'll have annuities, which is a one-page thing, which says, hey, turn in your selfies, I'll give you this, bingo. You take a 10% haircut because I'm bearing longevity risk, done, right? It could be that simple.
So this is fascinating, and I would just say let's like to understand how you would apply this in a very real environment. Hartford, Very interesting city. It's sort of second tier city. The city almost went bankrupt a couple of years ago. And there's some very structural issues there to manage the finances. So, for instance, a good portion of the tax base is owned by universities, owned by the state government. They don't pay any taxes. Okay. On top of that, you've had a number of unions who, over the years, I've been told, I haven't seen this. I've been told is there were points in time when if I worked for the Hartford, the city, if I worked 5 years, I had a pension for life, and these positions were passed to family member. Now, my understanding is a lot of the outflows are related to the pensions. What do you do there? I mean, is it? Well, we had a great mayor who kind of pulled the city back, but the problem's still there. What advice would you give them today?
So that's a tough one, because once you made existing DB obligations, right? And this is, again, one of my beefs. I think I wrote a piece, which I'll happily send you guys afterwards, which is the fundamental assumption in economics and finance that all of us were taught at some stage is so wrong that it's destroyed retirement security, right? So again, you're getting me on one of my Ramsey soapboxes again, which is academia ruined retirement security, right? So let me explain why. The first thing that we're taught about individuals or investors is that we want to maximize the expected utility of wealth. Okay? I don't know what the hell utility is. I've never seen it in 32 years of being in this industry. Even if it smacked me in the face, I won't recognize it. So let's throw that piece out, but just keep it for their benefit. We'll let them hang on to this beautiful little formula of Epstein's in utility functions, right? Makes them cute. The bigger problem was they said, we care about wealth, but wealth for wealth's sake has no meaning, right? I need wealth for one of two things, or maybe three things. One is for retirement, which means I need cash flows that only start at 65 for 20 years, indexed to standard of living. Fortunately, my kids have graduated, but for a while, another pool of my wealth was for their education, which was nothing till they're 18. Give me 4 years of cash flows indexed to tuition inflation, right? Maybe I've got a pet insurance. You can have various little goals, but for each goal, the cash flows are different, which means what you do with that and what's the safe asset is completely different. Now you look at your public pension plan in Hartford, and I'm not an expert on Hartford specifically, but I do a lot of work with public pension plans. They've been told to just announce an expected return that they have to get on their assets using Markowitz's optimization, which is complete gambling. Okay, the inputs are complete garbage because none of us have any clue what the expected return is. And I'll tell you about one disaster that I caused on 10 billion because I was trained that way, right? And here's the example. 1998, I'm asked to put the asset allocation in place for the World Bank, $10 billion fund. I call up your Goldman, I call up your JP Morgan, I call up your Morgan Stanley. I said, tell me what your expected return for equities is for the next 10 years, because that's one of the key inputs into my portfolio, into my model. Equities, vols, and correlations. What do you think on average the number was in their expected returns, 1998? Just give a guess.
I'd say I give a range between 7 and 9%.
Yeah, 9% was kind of where it was at, right? That time people were a bit more optimistic, but 9%. This is another slide I show my kids first day of class. What is the realized return over that 10-year period?
So this is from 1998 to
December 98 to...
Right. So you caught the crisis, you caught the GFC. So I'm going to say the low of the GFC was actually in March of 2009. So I would say you're probably down 20%, maybe. I don't know. Guessing.
Annualized, I was down 2, right? For 10 years. You're absolutely right.
Okay.
Right? Net, I'm down 20. I'm just doing simple math, right?
Yeah.
So I gambled $10 billion, okay, on a completely flawed set of assumptions, which people are still doing every day today. So, Paul, the problem you have is they've hired these consultants who are completely clueless about finance. I'm going to never get a business line from them, but I don't care at this point. And they've been gambling your pension money by making up these fake assumptions. And then they discount the liabilities with the expected return, which again makes no sense because Bill Sharp didn't put a stochastic liability in his capital asset pricing model, which he's admitted to me after the fact, right? Funnily enough, he writes a paper in 1990 saying asset allocation should be liability-centric. He never went back and said this is how it changes the capital asset pricing model. So because there's no liability in this capital asset pricing model, these guys are discounting it with the expected return on asset, which is completely crazy, right? So they've been gambling away your assets. The funded status they calculate is wrong. The hedging strategy is completely wrong because they should have been holding long duration bonds because that's their liability. Instead, they're putting it in private equity and private credit because they don't get mark to market, right? So in a sad way, you guys should file class action lawsuits as citizens against all these consultants because they destroyed your retirement wealth. I'm not kidding. I'm dead serious.
Yeah.
I'm calling up lawyers saying, listen, I'll be your first witness.
We know you're serious, and you're opening up one can of worms after another in this conversation.
Yeah.
But
No,
Ramsey,
well,
Ramsey,
realistically, I think we kind of come full circle back around to what you said is either you do increase taxes, and if you can potentially strangle cities like Hartford and other communities, or you cut benefits and you disrupt, retirement plans for millions of people.
But the sad part is the people who made the money and ran are the JP Morgans, the BlackRocks, et cetera, et cetera. And in fact, this is a fight I had with Virginia Retirement Systems, which is why they didn't renew me on the board, right? I was on the advisory committee. So here's where, again, it'll relate to Hartford and anybody else. You're in Atlanta or whatever, you're going to have the same problem. They've got a defined contribution plan for workers because now they don't offer defined benefits to anybody, right? They got smart and said, oops, we really don't know how to manage this risk. Let's stop taking it anymore. And that's why when Kathleen calls me 10 years ago for these uncovered people, nobody's willing to offer a DB because that liability is already too large on their existing pools. They're not going to take on new stuff, right? So here's your challenge now is you're looking at these pools of money and you're saying to yourself, let's run a DC plan. And so my wife currently teaches elementary school in the public school system. Now, fortunately, we're well off. I'm financially sophisticated. But she's surrounded by, young women who had graduated, largely women, making $27,000 a year, working, 7 days a week, spending their own personal money for classroom supplies. The only thing that the Virginia retirement system has to guarantee them is a bloody good retirement when they get out for putting in the pain, right? What's the default product at the Virginia retirement systems? A target date fund. Okay, so Ramsey, you're going to laugh your head off when I explain this to you. Okay? This is the question I ask my students. What is wrong with the target date fund? Right? Now, for listeners who are not familiar with the target date fund, it basically just changes your stock bond mix because you age 1 year, right? So there's a glide path which says, let's start with 70% in stocks because you're young. And then as you age, we'll drop it by 1%, for the next 40 years. And then we'll hit 30 and we'll flatten it out there, right? What's wrong with that product? Everything, right? First of all,
I was going to say because it's a single factor, but
yeah, first of all, it's a single factor, but it's a completely irrelevant single factor because if that's the factor, now this is going to get funny but depressing too. If that's the only factor, what does your retirement result become a function of? Not a trick question. My students in undergrad got it after I nudged them a bit. It's the only factor. So what does it become a function of, your retirement result? So it's age, right?
Well, it's a function of
your mortality. Your mortality and the returns.
Let me roll it back in reverse. Let's roll it back in reverse. Go to the other side of the spectrum. Mortality is death, right? When you hit 65 and they give you some amount of money, they don't give you an income stream, right? They just give you a pool of assets. That pool of assets was a function of what? When returns. You joined the work.
Contributions and returns.
Yeah, but because you're joining it and they're just arbitrarily changing the asset allocation, it becomes a function of when you join the workforce, right? Because you're getting in on a certain date and then that's what determines. What determines when you join the workforce? The day you were born. What determines the day you were born?
This is sort of an extended, sort of sequence of returns analysis, right?
No, but Ramsey, you're missing the punchline of this whole thing. What determines the day you were born? The day your parents got funky. Literally. The day your parents decided to have fun determines your retirement outcome. Nowadays there's enough mental health crisis. Just imagine having to worry about your kids' retirement as part of the, sort of getting busy concept. Right? It's really true. If you work out the math, this is how idiotic the product is, and Department of Labor has said it has QDIA status. So I started a fight within the group saying, how the hell can you guys allow such a product to be QDIA? And I spoke to BlackRock, the vendor, and I said, don't you know that this is the case? And they do. Because that glide path is completely arbitrary. The glide path takes nothing into consideration. It doesn't take your target desired income. It doesn't take market conditions. There's a whole bunch of embedded risks which they're not even managing, that you don't even realize they're not managing. And you're bearing all the risk and they take all the fees. Right? Class action lawsuit against DOL has to be filed because DOL has unleashed a weapon of mass destruction of retirement security. Because you have lawyers there who've never managed money, who never bothered to do anything except probably get, entertained by these asset managers and insurance companies. And that's the product we're living in as the default asset in 401k plans for unsophisticated people.
So we're bumping up a little bit against time here. But I do want to say,
you see the pattern.
Yeah, but here's my only pushback. I'm very clear on the limitations of target date funds. Very clear on the limitations of virtually every financial instrument I've ever sort of come across. There are some choices, but ultimately, the thing that those funds, target date funds, solve for is adoption rate, consensus around something, however imperfect. And in the alternative is people probably just wouldn't be saving. And so that's I won't give you that, Rand. I'm sorry. So that's it's just my view, right? This is my view.
So let me try to disabuse you of that view, right? And I could be completely wrong. Okay. So it's just by putting you in a bucket because you happen to have been born. I'm born in 1966, right? So I get put into a bucket just because I'm born in 66? No. If I'm very wealthy, I have a completely different desired asset allocation from you, let's say, who wasn't born as lucky. Now, listen, I came here with $15 in my pocket, so it's not like it's money's coming out of my ears. But it's also completely independent of your desired retirement spending. I could have very little money, but if I have very low desired retirement spending, I'm actually wealthier than you are. And this is a beautiful Socrates quote that says, don't be desirous of other people who have wealth until you know how they spend it, right? Socrates got it. It's not absolute wealth that matters. It's relative wealth, relative to your spending. So, Bob Merton has this brilliant example of what we have today in the market is you walk into a shoe store, somebody shuts the door and says, okay, the average size of all of you is 7, so everybody gets a size 7 shoe. This is Soviet style, production, right? It's completely a bonkers product. You should be revolting against it right after this call.
So again, I'm agreeing with the idea that it's not perfect, right?
No, it's horrible.
We have a different view on what the alternative is. Like for me, it's a behavioral distinction that like you have to come up with something that enough people feel comfortable with that they're taking an action, which is better than taking no action. And that's ultimately,
was it for you? Selfies.
But nobody's using selfies.
No, that's not correct. In Brazil, it's had very high success.
But not in the U.S.
And not only selfies, but also the education bond. Now, we'll come back to the U.S. being problematic for very different reasons. That has nothing to do with finance, right? One of the reasons this White House didn't touch it was because, and I know this for a fact, was people were scared that if Biden talked about retirement, people would realize he's old. Can you believe this? This is how judgment is needed. Listen, I took a boat from a banana republic here. I'm ready to actually take the boat back, okay? Because it's gone so bonkers. Literally, that was how the explanation was given to me as to why this administration. I met guys at U.S. Treasury who said, wow, this is a brilliant instrument. I said, what are you going to do about it? Answer is nothing. What is Janet Yellen doing? Going and talking about the Amazon in Brazil? Give me a break. Do your work, man. Come on. Right? Oh. She screwed up the central bank and now she's screwing all of us up for retirement. She should be doing this and nothing else. I'm sorry. Right? And I'm not political. This is not political. Yeah. I've had, debates with Trump's people, right? I had debates with Obama's people. Obama's people came up with this MyRA product, which was another disaster because they embedded a subsidy in it, at which point Treasury wants to kill it. Again, people who are not finance people, like, sadly, some of us, and lawyers should not be allowed anywhere near these pension policies. So right now, if people don't save in these horrible products, I'm totally happy with that. Because I'd much rather that they didn't spend money paying off BlackRock and State Street and JP Morgan for a gamble that they bear the risk on, and there's nobody else taking that risk. And they won't even. I asked the lawyer at the Virginia Retirement Systems offsite. I said, if I know the product that I'm defaulting people into is a problem, do I, as the trustee, have a fiduciary responsibility not to allow it? He said, oh, no, as long as you tell them, that this is a risky product. I said, yeah, but when I default them, which means they didn't make a decision, I put them in voluntarily into a gamble, which I know, and I know every one of these institutions, PIMCO, you name them, right? T-Rowe, they all know it's a gamble, right?
Yeah.
Have them agree to collect the fees when people reach retirement relative to their target retirement income. There'll be zero offering. Why does Larry Fink claim there's a retirement crisis all of a sudden? I posted on LinkedIn, you may have seen this. I said, Larry, you want to solve the retirement crisis? Give back all the billions in fees that you earned as part of your wealth for all the public funds in Hartford that you basically took the money from. So we've got a system where the top is being looked after by our politicians, okay, and the bottom is being basically plundered. And there's a beautiful book by Angus Deaton called Economics in America, Nobel Prize winner. Absolutely brilliant, where he documents it in every other area, but retirement. And I'm just trying to be the gadfly who sort of says that in our business as well.
You are successfully being the gadfly. So we're I think we're at the end. I'm going to hand it over to you, Paul, to wrap it up. This may even be 2 episodes. We'll see.
This easily could be. Arun, thank you so much for joining us. Listen, I love your perspective. It's there's nothing like bringing different people from different perspectives looking at the same problem, and you're right. It's we do need a fresh look to solve some of these problems that are going to come. They're going to come right up to the forefront in not many years. So I think it's better we have these kind of discussions now and get the problems on the table and start the discussion.
Because the cost goes up dramatically, right? Every year you postpone it, the cost rises dramatically, and the cost is going to be borne by our kids, right? And so for me, I wrote a piece called "Honey, I Shrunk the Kids' Wealth," right? And that's essentially what we are doing by not doing anything. Right? It's really true. And thank you for allowing me to join you. But what I really need for you to do is to join me, right? It's lonely. It's not fun. I get trashed a lot. And the beauty of it was up until a year and a half ago, everyone said, you're completely nuts. This is a crazy idea. Brazil launches it. It's a huge success. Brazil happens to be the G20 president. They did the education bond as well. Another huge success. And at some point, you want to do another call on how they've taken technology and allowed you to have a zero cost, zero risk, simple, tradable instrument that you can buy with $5 that's inheritable, right? Why can't
I love it.
Well,
why can't this do it?
There's so many other things. We've had hyperinflation, and I've been around long enough to see Brazil blow up a few times, right? You can have hyperinflation. So I've been in Brazil. I've been in Brazil and literally with a menu where they were erasing the prices and changing them between breakfast and lunch. So
but Ramsey, again, maybe this is the second episode today.
Yeah,
when Powell says inflation is transitory, he feels no pain. If he issued selfies, Yellen would be up his behind telling him, stop it, get it under control because it's costing me on the other end. There's no incentive compatibility in the way the system is set up. So if you don't have this, they can run inflation hard, right? So
all right. I'm going to have to call it for the time. To be continued. To be continued. Bruno, thanks for pulling Arun in. Arun, pleasure to meet you finally in person, and it won't be the last. So thanks so much. Thanks to all our listeners, Ramsey.
Yeah.
We will get you lunch here. Have it ordered to your house. And said, but anyway, hey, listen, join us again next week for another great episode of That Annuity Show. Thank you.
Thank you so much.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.